Hello and welcome to How to Econ. Let's talk about monetary policy. First, I will briefly introduce you to the Federal Reserve banking system and bank regulation. Then, I will explain how a central bank executes monetary policy and what the expected economic outcomes are. Finally, I will talk about what may prevent monetary policy from being effective. We call the organization responsible for conducting monetary policy and ensuring that a nation's financial system operates smoothly the central bank. Most nationals have central banks or currency boards. In the United States, we call the central bank the Federal Reserve or the Fed. Unlike most central banks, the Federal Reserve is semi-decentralized, mixing government appointees with representation from private sector banks. At the national level, it is run by a board of governors consisting of 7 members appointed by the President of the United States and confirmed by the Senate. Appointments are for 14-year terms. One member of the board of governors is designated as the chair. The Fed's policy decisions do not require congressional approval, and the President cannot ask for a Federal Reserve governor to resign, as the President can with cabinet positions. The Fed also includes 12 regional Federal Reserve banks, each of which is responsible for supporting the commercial banks and economy generally in its district. This map shows the Federal Reserve districts and the cities where their regional headquarters are located. The commercial banks in each district elect a board of directors for each regional Federal Reserve bank, and that board chooses a president for each regional Federal Reserve district. Thus, the Federal Reserve System includes both federally and private sector appointed leaders. So what exactly does a central bank do? The Federal Reserve, like most central banks, is designed to perform 3 important functions. First, to provide banking services to commercial banks and other depository institutions, and to provide banking services to the federal government. Second, to promote stability of the financial system. Third, to conduct monetary policy. Let's take a closer look at each function. First, the Federal Reserve provides many of the same services to banks as banks provide to their customers. For example, all commercial banks have an account at the Fed where they deposit reserves. Similarly, banks can obtain loans from the Fed through the discount window facility, which we will discuss in more detail later. The Fed is also responsible for check processing. When you write a check, for example, to buy groceries, the grocery store deposits the check in its bank account. Then the grocery store's bank returns the physical check or an image of that actual check to your bank, after which it transfers funds from your bank account to the grocery store's account. The Fed is responsible for each of these actions. On a more mundane level, the Federal Reserve ensures that enough currency and coins are circulating through the financial system to meet public demands. For instance, each year the Fed increases the amount of currency available in banks around the Christmas shopping season and reduces it again in January. Besides that, the Fed is responsible for assuring that banks are in compliance with a wide variety of consumer protection laws. For example, banks are forbidden from discriminating on the basis of age, race, sex, or marital status. Banks are also required to disclose publicly information about the loans they make for buying houses and how they distribute the loans geographically, as well as by sex and race of the loan applicants. A safe and stable national financial system is a critical concern of the Fed. The goal is not only to protect individual savings, but to protect the integrity of the financial system itself. Bank regulation is intended to maintain bank solvency by avoiding excessive risk. Regulation falls into a number of categories, including reserve requirements, capital requirements, and restrictions on the types of investments banks may make. Banks are required to hold a minimum percentage of their deposits on hand as reserves. On hand is a bit of a misnomer because while a portion of bank reserves are held as cash in the bank, the majority are held in the bank's account at the Federal Reserve, and their purpose is to cover desired withdrawals by depositors. Another part of bank regulation is restrictions on the types of investments banks are allowed to make. Banks are permitted to make loans to businesses, individuals, and other banks. They can purchase U.S. Treasury securities, but to protect depositors, they are not permitted to invest in the stock market or other assets that are perceived as too risky. Regulation requires that banks maintain a minimum net worth, usually expressed as a percent of their assets, to protect their depositors and other creditors. A bank's net worth is the difference between a bank's assets and its liabilities. Sometimes it is called bank capital. A bank must have positive net worth, otherwise it is insolvent or bankrupt, meaning it could not have enough assets to pay back its liability. Several government agencies monitor banks' balance sheets to make sure they have positive net worth and are not taking too high a level of risk. Within the U.S. Department of Treasury, the Office of the Comptroller of the Currency has a national staff of bank examiners who conduct on-site reviews of the 1,500 or so of the largest national banks. The bank examiners also review any foreign banks that have branches in the United States. The Office of the Comptroller of the Currency also monitors and regulates about 800 savings and loan institutions. The National Credit Union Administration supervises credit unions, which are non-profit banks that their members run and own. There are over 6,000 credit unions in the U.S., although the typical credit union is small compared to most banks. The Federal Reserve also has some responsibility for supervising financial institutions. For example, we call conglomerate firms that own banks and other businesses bank holding companies. While other regulators like the Office of the Comptroller of the Currency supervises the banks, the Federal Reserve supervises the holding companies. When bank supervision works well, most banks will remain financially healthy most of the time. If the bank supervisors find that a bank has low or negative net worth or is making too high a proportion of risky loans, they can require that the bank change its behavior or, in extreme cases, even force the bank to close or be sold to a financially healthy bank. Even a rumor that a bank might experience negative net worth could trigger a bank run. It is when depositors race to the bank to withdraw their deposits for fear that otherwise they would be lost. In a bank run, even healthy banks could be destroyed. Because the bank loans out most of the money it receives, and because it keeps only limited reserves on hand, a bank run of any size could quickly drain any of the bank's available cash. When the bank had no cash remaining, it only intensified the fears of remaining depositors that they could lose their money. Moreover, a bank run at one bank often triggered a chain reaction of runs on other banks. To protect against bank runs, Congress has put two strategies into place: deposit insurance and the lender of last resort. Deposit insurance is an insurance system that makes sure depositors in a bank do not lose their money, even if the bank goes bankrupt. In the United States, the Federal Deposit Insurance Corporation (FDIC) is responsible for deposit insurance. Banks pay an insurance premium to the FDIC. The insurance premium is based on the bank's level of deposits and then adjusted according to the riskiness of the bank's financial situation. In 2009, for example, a fairly safe bank with a high net worth might have paid 10 to 20 cents in insurance premiums for every $100 in bank deposits, while a risky bank with very low net worth might have paid 50 to 60 cents for every $100 in bank deposits. Bank examiners from the FDIC evaluate the bank's balance sheets, looking at the asset and liability values to determine the risk level. Even if a bank fails, the government guarantees that depositors will receive up to $250,000 of their money in each account, which is enough for almost all individuals, although not sufficient for many businesses. The problem with bank runs is not that insolvent banks will fail. They are, after all, bankrupt and need to be shut down. The problem is that bank runs can cause solvent banks to fail and spread to the rest of the financial system. To prevent this, the Fed stands ready to lend to banks and other financial institutions when they cannot obtain funds from anywhere else. This is known as the lender of last resort role. For banks, the central bank acting as a lender of last resort helps to reinforce the effect of deposit insurance and to reassure bank customers that they will not lose their money. The Federal Reserve's most important function is to conduct the nation's monetary policy. Monetary policy involves managing interest rates and credit conditions, which influences the level of economic activity. A central bank has three traditional tools to implement monetary policy in the economy. 1. Open market operations. 2. Changing reserve requirements. And 3. Changing the discount rate. Open market operations take place when the central bank sells or buys U.S. Treasury bonds in order to influence the quantity of bank reserves and the level of interest rates. The specific interest rate targeted in open market operations is the federal funds rate. The name is a bit of a misnomer since the federal funds rate is the interest rate that commercial banks charge making overnight loans to other banks. As such, it is a very short-term interest rate, but one that reflects credit conditions in financial markets very well. The Federal Open Market Committee makes the decisions regarding these open market operations. The Federal Open Market Committee comprises 7 members of the Federal Reserve's Board of Governors. It also includes 5 voting members who the board draws on a rotating basis from the regional Federal Reserve banks. To understand how open market operations affect the money supply, consider the balance sheet of Happy Bank displayed here. The top panel, Panel A, shows that Happy Bank starts with $460 million in assets divided among reserves, bonds, and loans, and $400 million in liabilities in the form of deposits, with a net worth of $60 million. When the central bank purchases $20 million in bonds from Happy Bank, the bond holdings of Happy Bank fall by $20 million, and the bank's reserves rise by $20 million, as Panel B shows. However, Happy Bank only wants to hold $40 million in reserves, the quantity of reserves with which it started in Panel A, so the bank decides to loan out the extra $20 million in reserves, and its loans rise by $20 million, as Panel C at the bottom shows. The central bank's open market operation causes Happy Bank to make loans instead of holding its assets in the form of government bonds, which expands the money supply. As the new loans are deposited in banks throughout the economy, these banks will in turn loan out some of the deposit they receive, triggering the money multiplier that we discussed in the video about money and banking. Open market operations can also reduce the quantity of money and loans in an economy. The first panel of this slide shows the balance sheet of Happy Bank before the central bank sells bonds in the open market. When Happy Bank purchases $30 million in bonds, Happy Bank sends $30 million of its reserves to the central bank, but now holds an additional $30 million in bonds as Panel B shows. However, Happy Bank wants to hold $40 million in reserves, as in the first panel, so it will adjust down the quantity of its loans by $30 million to bring its reserves back to the desired level, as Panel C shows. A decrease in the quantity of loans also means fewer deposits in other banks, and other banks reducing their lending as well, as the money multiplier takes effect. The second method of conducting monetary policy is for the central bank to raise or lower the reserve requirement, which is the percentage of each bank's deposits that it is legally required to hold either as cash in their vault or on deposit with the central bank. If banks are required to hold a greater amount in reserves, they have less money available to lend out. If banks are allowed to hold a smaller amount in reserves, they will have a greater amount of money available to lend out. The Fed makes small changes in the reserve requirements almost every year. In practice, the Fed rarely uses large changes in reserve requirements to execute monetary policy. A sudden demand that all banks increase their reserves would be extremely disruptive and difficult for them to comply, while loosening requirements too much would create a danger of banks' inability to meet withdrawal demands. The third traditional method for conducting monetary policy is to raise or lower the discount rate. This was the main tool for monetary policy when the Fed was initially created. In the event of a bank run, banks could borrow money from the Fed's discount window to stop the bank run. We call the interest rate banks pay for such loans the discount rate. They are so named because the bank makes loans against its outstanding loans at a discount of their face value. Once depositors became convinced that the bank would be able to honor their withdrawals, they no longer had a reason to make a run on the bank. If the central bank raises the discount rate, then commercial banks will reduce their borrowing of reserves from the Fed and instead call in loans to replace those reserves. Since fewer loans are available, the money supply falls and market interest rates rise. If the central bank lowers the discount rate it charges to banks, the process works in reverse. In recent decades, the Federal Reserve has made relatively few discount loans. Before a bank borrows from the Fed to fill out its required reserves, the bank is expected to first borrow from other available sources like other banks. This is encouraged by the Fed charging a higher discount rate than the federal funds rate. Given that most banks borrow little at the discount rate, changing the discount rate up or down has little impact on their behavior. More importantly, the Fed has found from experience that open market operations and changing federal funds rate are a more precise and powerful means of executing any desired monetary policy. A monetary policy that lowers interest rates and stimulates borrowing is an expansionary monetary policy or loose monetary policy. Conversely, a monetary policy that raises interest rates and reduces borrowing in the economy is a contractionary monetary policy or tight monetary policy. We will see how expansionary and contractionary monetary policies affect interest rate and aggregate demand, and how such policy will affect macroeconomic goals like unemployment and inflation. When describing the central bank's monetary policy actions, it is common to hear that the central bank raised interest rates or lowered interest rates. We need to be clear about this. More precisely, through open market operations, the central bank changes bank reserves in a way which affects the supply curve of loanable funds. As a result, interest rates change. If they do not meet the Fed's target, the Fed can supply more or less reserves until interest rates do. I will use this diagram to illustrate what I just said. Consider a market for loanable bank funds. The original equilibrium E0 occurs at an 8% interest rate and a quantity of funds loaned and borrowed of $10 billion. An expansionary monetary policy will shift the supply of loanable funds to the right from the original supply curve S0 to S1, leading to an equilibrium E1 with a lower 6% interest rate and a quantity $14 billion in loaned funds. Conversely, a contractionary monetary policy will shift the supply of loanable funds to the left from the original supply curve S0 to S2, leading to an equilibrium E2 with a higher 10% interest rate and a quantity of $8 billion in loaned funds. Of course, financial markets display a wide range of interest rates, representing borrowers with different risk premiums and loans that they must repay over different periods of time. In general, when the federal funds rate drops substantially, other interest rates drop too, and when the federal funds rate rises, other interest rates rise. However, a fall or rise of 1 percentage point in the federal funds rate, which, remember, is for borrowing overnight, will typically have an effect of less than 1 percentage point on a 30-year loan to purchase a house or a 3-year loan to purchase a car. Monetary policy can push the entire spectrum of interest rates higher or lower, but the forces of supply and demand in those specific markets for lending and borrowing set the specific interest rates. Monetary policy affects interest rates and the available quantity of loanable funds, which in turn affects several components of aggregate demand. tight or contractionary monetary policy that leads to higher interest rates and a reduced quantity of loanable funds will reduce two components of aggregate demand. Business investment will decline because it is less attractive for firms to borrow money, and even firms that have money will notice that with higher interest rates, it is relatively more attractive to put those funds in a financial investment than to make an investment in physical capital. In addition, higher interest rates will discourage consumer borrowing for big-ticket items like houses and cars. Conversely, loose or expansionary monetary policy that leads to lower interest rates and a higher quantity of loanable funds will tend to increase business investment and consumer borrowing for big-ticket items. Let's take a look at this with some graphs. If the economy is suffering a recession and high unemployment with output below potential GDP, expansionary monetary policy can help the economy return to potential GDP. Figure A on the left illustrates this situation. The original equilibrium during a recession E0 occurs at an output level of 600. An expansionary monetary policy will reduce interest rates and stimulate investment and consumption spending, causing the original aggregate demand curve AD0 to shift right to AD1 so that the new equilibrium E1 occurs at the potential GDP level of 700. On the other hand, if an economy is producing at a quantity of output above its potential GDP, a contractionary monetary policy can reduce the inflationary pressures for a rising price level. In Figure B on the right, the original equilibrium E0 occurs at an output of 750, which is above potential GDP. A contractionary monetary policy will raise interest rates, discourage borrowing for investment and consumption spending, and cause the original demand curve AD0 to shift left to AD1 so that the new equilibrium E1 occurs at the potential GDP level of 700. This example suggests that monetary policy should be countercyclical. That is, it should act to counterbalance the business cycles of economic downturns and upswings. The Fed should loosen monetary policy when a recession has caused unemployment to increase and tighten it when inflation threatens. Specifically, in expansionary monetary policy, the central bank causes the supply of money and loanable funds to increase, which lowers the interest rate, stimulating additional borrowing for investment and consumption, and shifting aggregate demand right. The result is a higher price level and, at least in the short run, higher real GDP. On the other hand, in contractionary monetary policy, the central bank causes the supply of money and credit in the economy to decrease, which raises the interest rate, discouraging borrowing for investment and consumption, and shifting aggregate demand left. The result is a lower price level and, at least in the short run, lower real GDP. Of course, countercyclical policy does pose a danger of overreaction. If loose monetary policy seeking to end a recession goes too far, it may push aggregate demand so far to the right that it triggers inflation. If tight monetary policy seeking to reduce inflation goes too strong, it may push aggregate demand too far to the left that a recession begins. In late 2008, as the U.S. economy struggled with recession, the Federal Reserve had already reduced the interest rate to near zero. With the recession still ongoing, the Fed had to adopt an innovative and non-traditional policy known as quantitative easing. This is the purchase of long-term government and private mortgage-backed securities by central banks to make credit available so as to stimulate aggregate demand. Quantitative easing differed from traditional monetary policy in several key ways. First, it involved the Fed purchasing long-term Treasury bonds rather than short-term Treasury bills. In 2008, it was impossible to stimulate the economy any further by lowering short-term rates because they were already as low as they could get. Therefore, the Fed sought to lower long-term rates utilizing quantitative easing. This led to a second way quantitative easing was different from traditional monetary policy. Instead of purchasing Treasury securities, the Fed also began purchasing private mortgage-backed securities, something it had never done before. During the financial crisis, which precipitated the recession, mortgage-backed securities were termed toxic assets because when the housing market collapsed, no one knew what these securities was worth, which put the financial institutions which were holding those securities on very shaky ground. By offering to purchase mortgage-backed securities, the Fed was both pushing long-term interest rates down and also removing possibly toxic assets from the balance sheets of private financial firms, which could strengthen the financial system. In the real world, effective monetary policy faces a number of significant hurdles. Banks are legally required to hold a minimum level of reserves, but no rule prohibits them from holding additional excess reserves above the legally mandated limit. For example, during a recession, banks may be hesitant to lend because they fear that when the economy is contracting, a high proportion of loan applicants become less likely to repay their loans. When many banks are choosing to hold excess reserves, expansionary monetary policy may not work well. This may occur because the banks are concerned about a deteriorating economy, while the central bank is trying to expand the money supply. If the banks prefer to hold excess reserves above the legally required level, the central bank cannot force individual banks to make loans. Similarly, sensible businesses and consumers may be reluctant to borrow substantial amounts of money in a recession because they recognize that firm sales and employees' jobs are more insecure in a recession, and they do not want to face the need to make interest payments. The result is that during an especially deep recession, an expansionary monetary policy may have little effect on either the price level or real GDP. Besides that, changes in velocity can also cause problems for monetary policy. Velocity is a term that economists use to describe how quickly money circulates through the economy. We define the velocity of money in a year as velocity equals nominal GDP divided by money supply. A higher velocity of money means that the average dollar circulates more times in a year. A lower velocity means that the average dollar circulates fewer times in a year. To understand why changes in velocity can cause problems for monetary policy, rewrite the definition of velocity so that the money supply is on the left-hand side of the equation. That is, money supply times velocity equals nominal GDP. But because nominal GDP equals price level or GDP deflator times real GDP, therefore, money supply times velocity equals nominal GDP and equals price level times real GDP. We sometimes call this equation the basic quantity equation of money, but as you can see, it is just the definition of velocity written in a different form. This equation must hold true by definition. If velocity is constant over time, then a certain percentage rise in the money supply on the left-hand side of the basic quantity equation of money will inevitably lead to the same percentage rise in nominal GDP, although this change could happen through an increase in inflation or an increase in real GDP or some combination of the two. If velocity is changing over time but in a constant and predictable way, then changes in the money supply will continue to have a predictable effect on nominal GDP. If velocity changes unpredictably over time, however, then the effect of changes in the money supply on nominal GDP becomes unpredictable. Another example in which expansionary monetary policy does not work is when an economy is at its potential output level. If the original level of aggregate demand is AD0, then an expansionary monetary policy that shifts aggregate demand to AD1 only creates an inflationary increase in the price level, but it does not alter GDP or unemployment. From this perspective, all that monetary policy can do is to lead to low inflation or high inflation, and low inflation provides a better climate for a healthy and growing economy. After all, low inflation means that businesses making investments can focus on real economic issues, not on figuring out ways to protect themselves from the cost and risk of inflation. In this way, a consistent pattern of low inflation can contribute to long-term growth, but an expansionary or loose policy would not help the economy. Many countries following this model and have their bank practice inflation targeting, which means that the central bank is legally required to focus primarily on keeping inflation low. The Fed in the US does not practice inflation targeting. Instead, the law governing the Federal Reserve requires it to make both unemployment and inflation into account. Instead, the law governing the Federal Reserve requires it to take both unemployment and inflation into account. Moreover, monetary policy affects the economy only after a time lag that is typically long and of variable length. Remember, monetary policy involves a chain of events. The central bank must perceive a situation in the economy, holding a meeting, and make a decision to react by tightening or loosening monetary policy. The change in monetary policy must filter through the banking system, changing the quantity of loans and affecting interest rates. When interest rates change, businesses must change their investment levels and consumers must change their borrowing patterns when purchasing homes and cars. Then it takes time for these changes to trickle through the rest of the economy. As a result, monetary policy has little effect in the immediate future. Instead, its primary effects are felt perhaps a few years in the future. In conclusion, it is not easy to design and execute monetary policy effectively, and one must be patient to realize its impacts. This is all for now. Thanks for listening. Please check out the video about fiscal policy as a complement to monetary policy.